Today's presentation is about securities lending. It's about short selling and how that affects the efficiency of markets. But I do want to link back to the past presentation where there was that wonderful cartoon with the tunnel and the couple standing outside the tunnel, and it said something along the lines of black holes, billions of dollars, investment bankers, heaven. And it caused me to think about an advertisement, well, not an advertisement, sorry, a news article this morning. And it was talking about the Large Hadron Particle Accelerator that's been built in the the mountains of Switzerland. And there's enormous worry at the moment, being propagated typically by the media, that this large particle accelerator will somehow open up a black hole in the middle of Switzerland and everything will collapse into it and the world will be over. And this struck me as typical. It was typical of the media. What happens with the media is they latch on to a particular story. They think this will sell newspapers or advertising space, and they fill the information vacuum with essentially speculation and sort of sensational headlines. And I think that's what we've experienced in this particular environment. Now, these are some headlines that were plucked that really support the case. These all happened, if you'll recall, at the beginning of this year, we had a few companies, including Orco that was mentioned earlier, going into a bit of a tailspin. And the newspaper headlines picked up on this, and they ran these sensational headlines: retirees at risk, stock lending racket exposed. Opus collapse could reveal a sordid tale of short selling super. Swan takes aim at short sellers' naked ambitions. Very sensational headlines and designed to sell newspapers, but not necessarily designed to really get people to understand the mechanism behind short selling and the mechanism behind securities lending and so forth, and what they mean in a marketplace. So the purpose today, what I'd like to do is I'm not going to attempt to convince people that this is a good or a bad idea. I believe that that's something that you have to decide yourself. But what I'd like to do is I'd like to shed some light on the practice, on both the practices of securities lending and short selling, and how that feeds into what we know as stock markets today. To do that, I want to talk about the who's, the whys, the hows, and so forth, so give a bit of an understanding of who's participating, and also to talk about some of the issues associated with stock lending and short selling. And then we'll feed through into the how it works in the market. So let's look at securities lending. Okay, who lends securities? Well, the lenders of the securities are the owners. They're the people, the groups that actually have legal title of those securities. And typically those are asset managers, if asset managers are responsible entities of trusts, for example, or indeed it's groups like yourselves with your large superannuation funds. There are others as well, but essentially the owners of the assets are the ones who are going to be lending them. And they lend them through a particular mechanism. Now, why? Why do they lend securities? Why are securities lent? Well, the reason why securities are lent is simple. Money. Or translate that into returns to the fund. So the aim of securities lending is for the lenders to make a profit on the lending of those securities. And that profit typically is shared by the fund and then the lending desk that does the lending in the first place. But the primary goal is to make money out of the process. And therein lies kind of the beginning of the problem. Because whenever there's an opportunity to make money, people often go a little bit too far in their efforts to make that money. And that can cause some serious issues. On the other hand, who's borrowing? Who's on the other side of the securities lending arrangement? Well, there are a number of groups there as well. There are short sellers These are these demons that have been pointed at by the newspapers. But there are different types of short seller. So people who are selling short will borrow securities. But it's not just short sellers. Brokers and market makers, and I want to focus more on the market makers, they will short securities in situations that are perfectly benign to the market. For example, if you happen to be a large institutional client of a particular brokerage house and you go to the broker and you say, look, I want to buy $100 million of shares of, say, AMP. If that broker thinks that they can easily source that information, they'll facilitate the deal and say, done, even if they don't have it. They will act as a facilitator for that deal to be done. And essentially, in doing so, they are short selling, but in the belief that they'll be able to cover their position at the end of the day or before the end of the day. So brokers habitually, as part of their business, will short sell to facilitate transactions in the marketplace. Why do borrowers borrow? Once again, there's a number of reasons. Some of them believe that they want to, well, they've sold short and so they're covering their short positions. So they'll borrow securities to cover those short positions. And others are just simply the financing or settling of trades. And we'll talk about each of these in turn in a bit more detail. But what I'd like to do now is look at the mechanism for lending securities out. So this is the first step. This is originating the loan. Now, on the left-hand side is the lender. That's the original owner of the assets. They're the ones who have the securities. On the right-hand side is the borrower. Now, the lender will say, I am prepared to lend you these securities, but in return for me lending you these securities, you must give me some kind of collateral, some kind of security that I can hold against that loan, so that if I call it back and you don't deliver them back to me, I've got some sort of surety, or I'm protected to the extent of the value of whatever I've lent to you. So let's just call that cash for the moment. So securities are passed from the lender to the borrower, and they go off and settle whatever trade they need to settle. The cash stays with the lender. The lender, with that cash, then invests it. And this is how the lender makes money. It's in the investment of the collateral that the lender is making money. Now, let's imagine it's just a very simple case of taking the money and investing it in government paper, for example. Over a period of time, they just earn a small amount of interest on it. And then when the borrower comes back and says, I want to close out the loan, they hand back the securities, but they've still got that interest. And what happens to that interest? Well, closing out the loan, and the loan can be closed out either by the borrower or the lender. So either party can say, look, I want to recall my shares or deliver back the shares. But by that stage, some sort of interest has been earned on the money that's acting as collateral. And that interest is then shared. Typically, some fraction is kept by the lender and some fraction goes back to the borrower. Depending on the nature of the securities that are being borrowed or lent, that's a large amount or a small amount. And so really, really liquid securities, like I mentioned AMP, you don't get much interest and collateral based on a security that's really, really liquid. On very, very illiquid securities, typically you're able to make more money. You're able to demand more of a collateral and keep more of the interest. But the point is that the shares swap hands again, delivered back, and the cash plus maybe a fraction of that interest is passed back to the lender, kept by the lender and passed back to the borrower. Now, what are the issues that exist in this process? Well, the issues really focus around reporting and the contractual arrangements associated with the deal between the borrower and the lender. Now, at this point, it's worthwhile me just explaining the chain of participants in this deal. On one end, this is the owner. You have, let's say, the superannuation fund. Now, you have ownership of the assets, but you don't physically hold them. Typically, you'll have a custodian who will have safe custody of your assets, of your members' assets. That custodian will generally have some form of lending desk. It's a big bank, they've got all sorts of other things happening. They'll have some form of lending desk, which acts as a kind of dealership for, to which borrowers come and say, have you got any shares of this company that I can borrow? That lending desk will look at its book and say, oh, look, we've got this over here. We're allowed to lend that out. Yes, we can satisfy your needs for this number of shares. So the owner negotiates a deal with the custodian, who has a deal with the lending desk, who subsequently has a deal with the borrowers. So there's this chain of participants, and information flow between these various participants is dreadful. And this is part of the problem, because typically the owners don't have any clue what's happening to the assets that are being lent out. They typically don't know who, and they don't know. They may have an idea of how much of their assets are being lent out, but typically they don't really have a good understanding. And part of the problem that we see is there's that lack of transparency in that whole lender, intermediary, borrower structure. And by the way, there is good reason for that lack of transparency from a borrower's perspective. If the borrower believes that they have some kind of knowledge that they're acting upon that they don't want to make public, they have an incentive to keep that kind of quiet. And that's why they're really secretive about what they're doing with, their short-selling positions. But nonetheless, there is an issue with that, and the whole communication thing going through that pipeline. The final one here is this issue of collateral. Now remember, when you lend out securities, you take collateral as a sort of surety, as some sort of security against those securities that you've lent out not being returned. And there are different types of collateral that you can accept. And I've categorized these into good and bad collateral. Good collateral is anything that's basically cash or cash equivalent. It's very liquid. You can basically, if it's not cash, you can get it into cash quickly. And it's also safe from any of the effects of what might be happening at the borrower's end. So if the borrower goes bust and you can't get your securities back, your collateral is still intact as if it's cash. The drawback to it being cash or cash equivalents is you don't earn a lot of money from the investment of just pure cash. Bad collateral, on the other hand, would be high-risk securities. Or, for example, take a really extreme case. If you had a listed entity wanted to borrow securities from you and as collateral delivered securities in its own company to you, so swapped the shares of the company it was short selling for its own shares, and then it went bust and you couldn't get your shares back, well, the shares you have as collateral have also gone from some value to worthless. So that's the sort of extreme case of a bad collateral delivery. But you can also take cash and really mess things up yourself. And this is this issue about making money off the cash. You invest the cash, this good collateral that you've received, and you've got a decision about whether to invest it in high quality, very low risk assets, or go for the money and invest it in junk bonds, CDOs and all that sort of stuff. And unfortunately, in an effort to really maximize returns without really paying much attention to the risk, a lot of people went the bad collateral route and the bad investment route, and they found themselves bitten when all this sort of credit crunch came around and bit them fairly and squarely on the backside. So first of all, you want to make sure that the collateral that you receive is good collateral, and then once you receive it as good collateral, you want to be very careful about how it's invested and how much money you're prepared to make from it. So it's common practice Securities lending happens all over the world. It's pretty common practice here. I would imagine that many of the funds in this room participate in one way or the other in securities lending. It's designed to increase a fund's return. The reason for it is increasing funds return. But there are issues relating to disclosure and transparency, and also this issue of collateral, making sure that the collateral can be quickly converted into cash if needs be. So that's on the one side. You've got the securities lending. Closely aligned with securities lending is short selling. So what is short selling? This is a little summary here. The sale of a security the investor does not own with the intention of profiting from a falling price, so that's one possibility, or hedging an exposure, or aiding the settlement of a trade. So there's kind of three main drivers behind this. The participants of short selling are the usual suspects. Hedge funds, they are major participants in this space. Traditional asset managers are also these, 130 funds are becoming more and more popular, and more traditional asset managers are not only long only, but long and short managers. Market makers, as I said, brokers who are facilitating transactions, and indeed brokers on their principal books will take short positions, although they have to be extremely careful that they're not acting on knowledge that they shouldn't be acting on. So there's a wide range of participants in this activity. As I said, there are three main drivers. The first is directional. And directional is when you believe that there's going to be a change in the price and you're trying to profit from that change in price. And I would like to categorize directional short sellers into two camps, one good and one bad. The good camp, and in my view is perfectly acceptable, are the managers who say, we believe, we have an opinion, we've drawn some sort of conclusion from our research that this company's stock is overvalued, and therefore we're going to short it. Right? But they're not trying to push the price, they just believe it's overvalued and they believe that there will be a correction. But they're not necessarily aiming to create or generate that correction, they just believe strongly in their research and their opinions, and they're taking a view and acting on it. And I think that is entirely appropriate, and that's the sort of activity that should be encouraged. Now on to the bad side. The bad side are what are often described as the market manipulators. These are the ones where they see some sort of opportunity to get in and kick them when they're down and try and market and manipulate the price. In other words, it's not that they have a view that the stock is overvalued in an intrinsic sense. They have a view that they can actually manipulate the price and push it down to their advantage. And that's market manipulation. And that's something that I think we should all be very careful and aware of. On to the arbitraging or hedging side. This is typically non-directional. It's just hedging out an exposure to a particular stock. It can happen in many instances where stocks are going in the same direction. You just have a view that one stock is going to do particularly better than the other. And so you short the one you think is not going to do as well as the other one and invest in the other one. So it's non-directional, but it's a way of hedging out exposure to one of the companies. And then market making and settlement liquidity. Now in terms of putting it simply in some phrasing, the directional participants, be they good, bad or indifferent, what they're doing is they're selling a security that they don't own intending to buy it back more cheaply so that they can profit from the transaction, from an expected fall in price. The arbitragers or the hedgers, they sell a security they don't own, so that's the same. They intend to buy it back at a later date, so that's the same as well. But the driver behind it is to reduce exposure to a particular security. And it doesn't really matter which direction the security's price goes in. Market making and settlement, where a participant sells a security it doesn't own, intending to buy it back at a later date so they can provide liquidity or aid settlement. But what I'd like to do is I'd like to tease out one that I see almost daily in the markets. And that's something that I would describe as accidental short selling. And I know that fund managers do this all the time. A participant unintentionally sells a security that they don't own. It's not so much that they intend to buy it back, it's just they seek to buy it back as soon as possible. And they want to buy it back as soon as possible because they don't want to get into trouble, because they've done something they shouldn't have. And you see that all the time. You see this sort of accidental short selling. And the whole point about short selling and how it's kind of grown in the marketplace and the securities lending industry, how it grew as well, is simply as a result of making sure that T+3 short-dated settlement can occur really, really effectively and efficiently, and that these little accidental sales don't jam up the market. And these accidental sales may be purely as a result of, say, a company has had a corporate action where they've had a dividend reinvestment plan, for example, and the portfolio manager looked at his or her records and said, oh, I think I've got 40,500 shares of this particular company. I want to sell that, so I sell 40,500. Turns out that 500 was a dividend reinvestment proceed that hasn't arrived yet, hasn't been delivered, hasn't settled. And so they've accidentally sold 500 shares short. No kind of nefarious intention there whatsoever, just a record-keeping issue. So the 500 shares is borrowed from somebody else, settles, and it's all clean and sweet. And then at the end, when the 500 shares are delivered, the transaction settled down, closed down. So that sort of stuff happens all the time. Now, there's some terminology here, which sort of gets you a feel for the mechanics. These things like naked shorts and covered shorts and so forth, the kinds of names that are absolutely, the meat that the media really like to get their teeth into. But a naked short and a covered short, and it's important to kind of understand the difference. A naked short is where, in its most generic term, a naked short is when you sell a security you don't own. That's kind of its most generic. But, as is always the case, where there's a kind of little wedge or thin hole you can start banging a wedge into, it becomes ambiguous, this whole difference between a naked short and a covered short. What about if you've already borrowed the security before you then sell it short? So you've already kind of covered what you're going to do. Well, a lot of participants, hedge funds in particular, consider that to be a covered position, and that's now become a covered short. Problem is, there are different reporting requirements in the Australian market between naked shorts and covered shorts, and it means that if you've already covered your short position, you don't actually have to disclose it as a short when you do the transaction after you've borrowed the stock, which you would have to do if you'd done it the other way around, in other words, short it and then borrow it. So by simply reversing the order of the transactions, even if you haven't changed the intent whatsoever, you fundamentally changed the reporting requirements. And that's one of the problems that we face. And I think the government is looking closely into changing the rules concerning that kind of reporting requirement. So this definition is somewhat ambiguous and leads to this underreporting. And it comes back to transparency within the marketplace. And quite frankly, whilst these are the sorts of things that hit the headlines, these transactions are not necessarily the ones that are happening on a daily basis. They are headline hitters, but they're not really the bulk of what's going on in the marketplace. But we still need to be concerned about this kind of behaviour, because it does tend to lead to the attempts to manipulate prices and manipulate the market, which, as I said, in my view, is the wrong sort of use. It's an abuse of this kind of mechanism. So short selling, for the most part, is a normal business activity. It's there to assist people in having the courage of their convictions, if you will. It allows them to take a position on their research, for example. It also helps people arbitrage out or hedge out positions against particular companies, and it also helps in the settlement process in the marketplace. So there are a range of different participants. There's a range of different reasons why participants use short selling. And not all of those are related to falling prices, or in other words, a price movement down. It's not all directional. But, as I said, there are issues with short selling that we need to be aware about, related more to market manipulation. So let's have a look at some of the regulators' views on this topic. This is one from the ASX, a recent, well, relatively recent, at the time of this all happening. The ASX came out and stated quite categorically that they support short selling as being legitimate and being part of a normal and properly functioning market. And indeed, the reasons why they were coming out was because they could see that most people use it as a mechanism that's got nothing to do with market manipulation. The Reserve Bank has, in similar vein, supported the concept of securities lending and short selling, but they've also been aware of some of the issues related to transparency and the reporting of short sales. And it's all about that ambiguity of what's a covered short, what's a naked short, what should be reported, what shouldn't be reported. The government, in the form of Senator Sherry, has made a statement on the topic, I believe in the recent IFSA conference, and has said that, they believe that it adds liquidity, it aids, it helps in price discovery, but there are some activities that should be more closely looked at. And there's some activities that he's talking about are these issues to do with market manipulation. And if we cross over to the States, where they've obviously had very similar issues, the SEC, as is typical of the SEC, came down with a sledgehammer. They made a very bold statement saying that anybody who is misrepresenting what they're doing in the marketplace, so they go out selling with no intention of covering that sale, and not properly reporting it and doing, essentially market manipulating. They believe that that's abusive, and they termed it abusive naked selling, and they believe that to be illegal in every circumstance. Not under the SEC rules, but under the various the 40 Act rules that they operate under. Anyway, the SEC is very keen to make sure that market manipulation does not occur in the marketplace. But let me sort of step back a moment here. I like to think of something like this as sort of a normal everyday activity that happens in the background. You don't necessarily see it happening, but you benefit, perhaps unknowingly, from the consequences of it happening. And the way I look at it is it's a little bit like driving a car. Now, most of us, if not all of us, drive cars, and we all drive perfectly safely. But we all know that there are people out there who drive incredibly badly and incredibly dangerously. Yet somehow they still manage to get a license, get access to a car, and go and do the things that they do. If we were, to suddenly say, well, just because of that tiny little minority of individuals who can potentially cause death and injury to innocent bystanders or themselves, if we just said, well, let's make the rules to cover that tiny minority and say, well, nobody can drive, the effect on our daily lives would be enormous. To some extent, to a lot lesser extent, securities lending and short selling is somewhat similar. For the most part, most of these transactions are perfectly innocent transactions. And if we were to abolish them, for example, there would be a very significant effect on the way markets worked, the effectiveness, the price discovery that they encourage, and indeed not just the price discovery, but also the settlement process, the ability to make sure that securities were delivered in a prompt fashion. So those sort of issues would start to clog up the system, and I think that's why the regulators, the banks and the government, are so keen to keep securities lending and short selling as part of the market function. But they are very keen as well, and should be encouraged, to make sure that those mechanisms are not abused. So just in recap of this, we've got, it's normal part of the marketplace, happening every day. It's securities lending, essentially is a way to increase funds return. You've got to worry about the collateral issue. You've got to worry about communication between the chain of participants. And stock lending, short selling, is, on the other hand, also a part of this whole process. And short selling is a way to encourage price discovery in many respects, but it's also a way of aiding settlement too, and perhaps allowing people to slightly alter the shapes of their portfolios to achieve a particular risk end. Now that's the end of this rather short and succinct presentation on short selling stock lending.